Hi, I'm Arjun Patsati, INR Bonds, and I'm very happy to announce the weekly podcast, Let's Talk Bonds, targeted largely towards financial advisors and investors who are keen to understand the options available to them for in the fixed income markets for investments. As we all know that given the last 2 years, equity markets have been very strong, but going forward at very high levels, there is a lot of concerns on valuations. And with the interest rates at extremely low levels, investors are finding it tough to understand where to invest in the fixed income markets as well. And where do they search for returns in the fixed income markets? And especially now with interest rates looking to rise, what are the options available for investors? I'll just take you through a snapshot of what's happening in the market and what are all the yields that are available for investors and where they need to look to invest for their investments in the near future. If you just a recap of where the main benchmark bonds, which is the government bonds, are trading. The 1 year government bond is at 4.4%. The 3 year government bond is at 5.35%. The 5 year government bond is at 5.9%. And the 10-year government bond is at 6.55%. If you go up, 15-year and 30-year bonds are at 7% and 7.2% respectively. And state government loans, SDLs, they are trading at around 7.10%. And for many investors, in looking at bond ETFs, Bharat bond ETF levels, the 3 year Bharat, the uh, the the 2032 Bharat bond, which was issued recently, that's now gone up to around 7.07%. It was issued at 6.87% in the last month. The 2031 maturity Bharat bond ETF is trading at 6.94%, while the 2030 Bharat bond is trading at 6.93%, and 2025 Bharat bond is at 5.73%, and 2023 Bharat bond is at 4.89%. So if you look at the top rated bonds, Bharat bond, as we all know, is the PSU, is a mix of AAA rated PSU bonds or government owned bonds, the public sector bonds, and the government bonds and SDLs, which is the safest in the market. The yields are anywhere between 4.4% to 7.2%. But if you start look at higher yields, which is around 7%, you have to take the risk of rising high maturities, which is 10 years plus maturities. And this exposes you to the risk of high rising interest rates in an inflationary scenario. Now, going down to corporate bonds, that's where investors see some kind of extra juice, which is protecting them against inflation. The bonds like AAA rated bonds like HDFC and LIC and Bajaj Finance and very strong companies which are AA rated plus like Muthoot Finance, etc. They are all trading in anywhere between a range of around 5.5% to 6.5 to 7%. And again, if you go to 7% and over, you're exposing yourself to higher interest rate risk because the maturities are over 6 years to 6 years plus and going up to 10 years all the way. So clearly, up to 8%, if you're really looking at it, all the very high safety bonds are either giving you very low returns if you want to take out interest rate risk from your investments as interest rates are looking to rise given inflation. But if you want to get extra yields, you have to take longer term maturity bonds. But again, that exposes you to higher interest rate risk. So where are your options available? So you have bonds now that you have to look at lower rated bonds that are seeing reasonable traction at the retail investor level. These bonds include bonds like Shriram Transport, where 3-year bonds are closer to 8.5% to 9%, depending on what kind of bond it is. Then you have Piramal, which has got a 10-year bond, which is at closer to 10.5%. Then you have microfinance companies that are trading in the range of anything between 9 to 11%, or even 12% for some of them. Some of these companies are pretty okay. There are new kids on the block like Navi Finance. They are also issuing bonds over 9% levels. Uh, and with, investors are now seeking all these bonds, and also they are also seeking, especially ultra high net worth investors are seeking also some kind of a tax benefit. So they are investing in market linked debentures of many of these issuers at over 9% levels, so that they get a tax benefit as well. That their own view on the tax. So we are not commenting on the tax here. And again, bonds like state government bonds, of which the most actively traded is UPPCL, which is the UP Power Corporation. That bonds are trading anywhere between, for 1 year bond is at around 6.75%, to 6 and 7 year bonds are closer to 8.5 to 9%. So that's investors are have to either go in for high safety, but if they go in for high safety, they have to take longer maturity, which exposes them to interest rate risk, or they go in for good bonds that are in a shorter maturity, 2 to 3 year kind of maturity, which is yielding anywhere between 8.5% to 10% or 11%, depending on the bond and the issuer. And but if they have to the risk of investment in these bonds. Now, so taking advantage of this scenario, there are many private placements and public debt issues that are happening. So last week we are seeing good amount of issuances. We have India Bulls Housing that is coming out with come out with private placements, 3 to 5 year bonds, all the way going up to 9.25% all the way. Then you have Navi Finserv, which is floated in 1 year bond at 9.18%. You have companies like Reliance Geo. Again, that is a very big offering, a 5 year bond at 6.2%. Then you have companies like Swatantra, Housing Finance and Microfinance, offering bonds anywhere between 6 year bonds between 9.5% to closer to 12%. These are some of the that you have again on a public debt issue. Muthoot FinCorp, which is offering 27 months to, which is offering bonds anywhere between 8.5% to over 9%. And with all this, I think the investors are seeing a lot of these companies trying to grab their attention, and many of the bonds that are available also are forcing them to relook at where their investments are going, where their investments. And as investors all know that mutual funds, if they invest in mutual funds are also subject to where the market levels are. So mutual funds who are offering very high safety, again, the yields are low and returns are low. And if they go up the maturity scale, they're exposing them to higher interest rate risk. So these are the levels of the bonds in the market at present. And we will keep you updated on a weekly podcast like this. And also, as we go along, we will expand more. We will invite the guest speakers to discuss on bonds. What are the offers available for financial advisors within the client's portfolios, or for investors to invest, the merits and demerits of each bond, etc. And yes, thank you for listening in. And do subscribe to us once if you like this podcast.